This is The Roadmap with Ted Jenkins.
Hey everybody, welcome to The Roadmap. I'm your host, Ted Jenkins, exclusively here on America's Small Business Network. You know, every week, folks, I try to bring you some of the brightest and best CEOs and entrepreneurs and business owners all around the United States. I love looking at blue-collar businesses and white-collar businesses, startup businesses and mature businesses, so you too can figure out, how can I start a business? How can I grow one? And maybe one day you can exit stage left. I'm excited today. I have Michael Davis with me. He's the co-founder and CEO of Homegrown. I'm fascinated about the model that you built today. So I want to know, how did this come about? How did you start Homegrown? Where did this idea come about?
So Ted, my parents are entrepreneurs. We went through the journey of starting a company when I was a kid. And unfortunately, at the beginning, it didn't work.
Did not work.
No, it didn't
like
work.
Most businesses.
Like most businesses. And entrepreneurship is this great, beautiful thing, but it's also terribly hard. And my entire childhood was very much defined by seeing my parents and working with my parents as we struggled to find support, not only operationally, but also especially for capital. We were very capital constrained and it created a lot of problems. And so I always knew that throughout my life, I wanted to come back and build a company that actually would help entrepreneurs and provide financing as well. So,
isn't that the number one reason though?
Totally.
Most businesses fail? I've seen over time that undercapitalization.
Yes.
You know, you always tell people that you basically got to measure twice and cut once, yet still they start a business. It's like, gosh, I didn't expect all these expenses. I didn't expect that I would have to go get equipment or whatever it may be. So is this what the business does in Homegrown? You provide capital to what kind of businesses?
Yeah, so you are completely right. Financing is the most acute challenge that faces entrepreneurs in America. Right. But what Homegrown does is we focus on financing brick-and-mortar businesses. So let me just quickly define what a brick-and-mortar business is.
Yeah.
It is not just a restaurant. A brick-and-mortar business is a yoga studio. It's your chiropractor. It's your doctor's office. It's any place that a retail consumer can walk into. So we will not finance technology companies, but we will finance a place that you could take your family and go and spend time in a community.
So I want to say this right, because this is going to sound like a mouthful, folks, when I say this, because the business model provides single source, non-dilutive expansion capital without personal guarantees.
That's
there
right.
I said
that
it.
Was a lot.
Out of my mouth at one time.
Awesome. You did awesome, Ted. So let me break this down.
Yeah.
Most people sell equity, and equity is just ownership in your company, and they use that as a way to finance growth. The problem with doing that is that if you have a business that is growing and you sell equity or you sell too much of it, you're getting rid of your own ownership. And over time,
why do you want to
that
dilute
is how
yourself?
You talk about exit stage left, right? Like, you want to have a lot of ownership. And so what we do is we allow proven entrepreneurs who have multiple locations to access capital without taking their ownership. And that's one of the most powerful things that we do. The second thing is that our capital does not come with this thing called a personal guarantee. A personal guarantee is, for those of you who don't know, a personal guarantee is when you have to actually personally guarantee the loan you are getting from a financial institution. So that means that all of that you are worth, everything you have saved, if you have a mortgage, everything is on the line when you take that kind of debt. Homegrown does not do that because we don't believe that entrepreneurs should have to do that in order to grow.
But you're making an important point, because when you go to the bank and you get a loan because you're desperate to get 200 grand of money, the bank says, hey, you have to sign a personal guarantee, and people say no problem. Then after the fact they go, wait a minute, my home is on the line?
Yes.
My cars, my brokerage accounts,
yes.
Everything's on the line, right? When you sign a personal guarantee, it literally means we don't really care. If you can't pay this back, all these other assets that you have over here, they're ours. So the bank sort of de facto becomes like The Sopranos, right? They're not going to break your legs, but they're going to come take your money.
They're going to break your livelihood. And that's what happened to my family when I was a kid. We went bankrupt. And it was terribly hard. And fortunately, my parents had the drive to try again. And when they tried again, the company did work. And so I saw the actual horror of what happens when you have a loan like this that does not work. And when you do not have to worry about, I have an 11-month-old son.
Right.
I want to be able to build a company without feeling like I'm jeopardizing his future by doing it. And I think in a way, this way of financing we do allows entrepreneurs to
So
actually
let's
achieve their
walk
dreams
through
more.
an example so people understand this. I
Yep.
own Globo Gym.
Yep.
You know, it's
Loving
I've got this great gym. It's growing. I've got 2 locations now. They're successful. They're now profitable. But I want to open up a 3rd gym.
Yep.
And I go to Homegrown, and you guys will basically loan me the money to start that 3rd gym.
Yep.
I don't have to guarantee my other gyms against that loan, or my house, or my firstborn, or whatever it may be, right? And then how do you get paid back?
Yeah, so the way that we can forego or not do a personal guarantee is that we take a small percent of the revenue across all locations.
Oh, yeah.
And we do that every month. And so this is a little bit of how Homegrown is different. There's a overwhelming avalanche of financing companies that all fundamentally are doing the same thing. We are very different. Our paybacks, we call them paybacks, are based on your monthly revenue. So if you have a slower month, you actually pay us less. If you have a higher growth month, you pay us a little more. And in that way, our interests are actually aligned. And the key thing with our model is we back companies like Globo Gym that have multiple locations that are working. And the reason why is because our capital comes from mostly local investors who are the ones funding these businesses. And so we want to make sure that those investors have security, and at the same time, we save the entrepreneur from having to spend hundreds and hundreds of hours financing. You know.
So you may have Globo Gym that says, I need $1 million. You go to investors, you have $1 million. What kind of return, I guess on both sides of it, can the investor expect, and what kind of, I don't want to say interest rate because it's not done that way, but what kind of interest in general would an owner or payback would the owner expect to pay?
Yeah, we like to call, and I'll be careful saying this, we like to call our product SBA Plus. So we're a little bit above.
The government loves that.
We're a little bit above where the government lends, but we don't do personal guarantees. And the SBA requires personal guarantees. And we also get funding decisions very quickly.
More than that, it's about 8,000 pages of paperwork. It's unbelievable.
It is quite a bit to go through. And so that's one of the bigger changes. So that's on the business side. For the investors, I can't publicly state exactly what the return profile is, but what I can tell you is we consider ourselves to be a part of this industry called private credit. And within private credit, our return profiles are in the top 10% of what you would expect.
But normally targeting a 10+% rate of return.
Correct.
Is that fair? It's going to be double digits in general.
And in exchange for that, as an entrepreneur, you don't have any personal risk. And so
it feels to me, and boy, Mr. Wonderful on Shark Tank would love this, that it's not quite a royalty deal because it doesn't go in perpetuity.
Correct.
But it feels a little bit like venture lending or venture debt, so to speak, where I might, for the folks that don't know about that at all, like you might loan someone $100,000 and say, look, when I get back $200,000, we're done, right?
Correct.
But it feels like that in general.
That is exactly correct. We have what we call a payment cap. So after a business has paid back a certain amount, it's principal plus interest, it's done. And so our pitch to entrepreneurs is, you have a growing business that does really well. You want to increase the valuation, the equity value of your company. The best way to do that is to open more locations, earn more revenue. We're going to help you do that. But unlike equity investors who will take that percentage of your company forever, you pay us back a certain amount, we're done. And so just as an example of something we've helped companies do is, we have one client, I can't share the name publicly. They have 18 locations now. When we started working with them, they had 8.
That's unbelievable.
8. Their revenue has almost 4x'd, increased 4 times over.
Right, which is going to be their sale value down the road.
Correct. But they were able to do that without selling their ownership, which that's one of the things I'm most proud about. My family business, we sold about half of our company when we started, and I wish we wouldn't have done that. I wish my parents had a way to finance growth without giving up our equity.
It is a mistake a lot of owners make because new owners especially that don't really understand how powerful the equity is. They're like, hey, give me $100,000, you can have 15% of the company. Then you realize 7 years into it, those other people aren't working, they're not involved with the company, they don't have the same, all they risked was a little bit of capital.
That's right. And for us, we love our entrepreneurs.
So one of the interesting things in talking about this model is that you must have to do a lot of analysis
We do.
to screen out whether somebody is a good risk or not? Now, there's nothing that's infallible, right? There can always be some risk, but how do your analyst or yourself or everybody involved, how do you try to screen out risk?
Yeah, so it's really cool. A lot of we call this diligence or underwriting.
Right.
A lot of this is automated on our team, but a bunch of what we're doing is we actually look at the fundamentals of a business. Many lenders today will look at one type of data and one type of data alone, which is your sales data every month. That might seem smart, and it is, but let me tell you what that's not giving you. It's not telling you the debt load of a company. It's not giving you a look at their balance sheet or their cash flow or the actual fundamentals of the business.
Right.
We look at all of that, and then we actually work with management to understand where do you want to go. And in addition, there's one more thing we do that's really cool, which is for specific types of businesses, we actually have people who have built and in many cases sold companies in a specific segment that we go to for a specific subject matter
So you
expertise.
got better at it. You get better at those the deeper that you're into it. And really, your risk over time, obviously, and it's not all the risk, but the business goes out of business because even cyclicality might reduce return, but it doesn't make the money go away, right?
That's one of the beautiful parts about our model, and this is one reason that our investors do love our product is oftentimes when you do buy equity, like people on Shark Tank do, sometimes, it's forever, right? With what we're doing, we give entrepreneurs and the investors the ability to get a good monthly return. And so even if the company just does not work, let's say that 2 or 3 years in, it doesn't work. In order for it to not work, they have to have all their locations closed, which is one of the reasons why we back companies with multiple locations, because it gives investors what we like to call capital redundancy. So that even if let's say back to Globo Gym opens a third location and it doesn't work, our investors won't be totally screwed. Like they actually still have revenue from the other 2 locations.
And is the model for you as the owner in the business that you're participating along the way that maybe whatever it may be because it's not a management fee, or how does that work?
Yeah, so what we love to do is to back companies multiple times. We want to help entrepreneurs who have dreams achieve those dreams, and that oftentimes means the client I alluded to earlier, where you start off with 7, 8 locations, and then we can quickly enable you to grow. We love doing that. And in that way, we are sort of a replacement for equity. And that's one of the most common ways the entrepreneurs we back describe us as a replacement for equity.
When you assess these companies, do you see the future of the company that you'd have to hire more analysts, or will there be an AI-driven model that you could move this quicker to screen pass fail when you're thinking about bringing on a company?
Yeah, we're going to do both. I think you'll see different elements of us automating more and more of what we're doing. We've already begun that journey. I think when you're doing that, you need to be very thoughtful before you release stuff. And then over time, we think there's something really special about having a local orientation. That's one of the ways that Atlanta has worked so well for us, is our team focuses in on this market. And I think that's a really important strategy. I think you'll see us continue to build like that.
How do you scale the business faster?
Yeah, so one of the things I love is we don't actually have to go find a ton of new customers.
Right.
We can continue to grow really quickly by simply continuing to support the entrepreneurs we've already brought into what we call our homegrown family. I know it sounds corny, but that's a big path of growth for us. We are very busy simply supporting the entrepreneurs we've already.
You can get a half dozen businesses that you understand the model, you can keep doing more. You just have to go fundraise, if you will, and find the people that want to invest in the business. Correct.
And you know, and again, I am not selling any securities at this exact moment on TV with you, but the pitch to our investor base is very good. You get strong returns that are consistent. We give monthly distributions, and at the same time you get to support small businesses, and in many cases businesses that you know and love. That Ted, you will drive home today and you will pass companies.
You just see them on the highway or on your main street.
Yes, near our office in Midtown Atlanta. I walk on the Beltline and it's beautiful. I get to walk past many companies that Homegrown and our investors have empowered, and I can look at locations. And
how long is an investor's money locked up in general?
Anywhere from 3 to 5 years on average.
That's not bad.
It can be a little shorter, it can be a little longer. There's some nuances in our product that
allow it. And it depends how fast, I guess, the business scales up revenue, right?
Correct.
Faster they scale up, the quicker. Slower, it could take a little bit longer.
Absolutely, and we are always conservative on the growth rates we expect. We always communicate very clearly with our investors because this is alternative investing. And when you do alternative investing, there's higher risk. That is the way it is. And so one of the things we are very thoughtful about is being methodical. And so this is another reason why fast growth is not our priority. We want to grow in an intelligent, smart way.
Yeah.
And then when we're ready to go faster, we will.
You know, people say that, and I know that I'd be pitching something here in general, but they say alternative investing is more risky. But to a degree, I've seen a lot of these private lending kind of models. And if you're funding a business here that is a restaurant chain, or let's say it's a nail salon chain or a Globo gym,
Yep.
and they've successfully done 10 businesses, I would argue to anybody, what have you seen go broke more in the last 10 years? Banks or this business? And that's how
Yep.
you assess the risk profile, because I've seen this in a legal business as well. Very interesting, loaning money to personal injury attorneys.
Yeah.
And I asked somebody the other day, I said, what did you see go broke more in the last 20 years? Personal injury attorneys or banks? And it's banks every time. So then you just ask yourself, where
Yeah.
is there really more risk? And if you're screening out the risk, I mean, yes, I guess you have to make that disclosure. It's more risky, but I don't know if it's that case all the time.
You know, I'll piggyback on what you're saying. Over 70% of spending in the U.S. economy happens in brick and mortar establishments. Most people don't realize
Right.
that. That is a lot of expenditure
Right.
happening in a community. And brick and mortar is the backbone of our country and our communities. We are backing those companies. And you're right. People are going to get their nails done. People
Yep.
will always go grab
Always.
coffee. People are going to go to co-working spaces. They're going to eat food. They're going to go to the doctor. They're going to do their yoga classes. That's not changing. It's been that way for a long time, and it will continue to be that way for the future, and that's the future we want to create.
Well, Michael, I appreciate you sharing your story. Not only
thanks.
not only your parents and coming from that entrepreneurial background, but building the model that you're building today, because you're not only building a great business you may sell one day, but you're helping lots of other small businesses grow, which is kind of a 2-for-1.
Yeah,
so
it
I
very much
like
is.
it. You know, folks, this is where everything heads over time. There are new ideas all the time. What an opportunity. You ought to check out Homegrown and see what they're doing. Maybe you do it as an investor. Maybe your business could be one that could be funded down the road. But this is how it happens in this country, with great business owners that come up with great ideas. I'm Ted Jenkins, your host. Thanks so much for watching The Roadmap every week, exclusively here on America's Small Business Network.
Thanks for watching The Roadmap with Ted Jenkins.